Hello everyone. Today we are going to talk to you about Ind AS 20. Ind AS 20 covers accounting for government grants and disclosure of government assistance. Now government in a way provide assistance to companies and to citizens at large in various forms, right? And one of the most common form is what we see when government do provide assistance is by way of tax incentives, right? Now, anything which they provide in the form of a tax incentive, which takes the color of direct tax, right? Income taxes, so to say. Let's say in the form of a tax holiday or any other incentive, that is not part of the scope, right, of this standard, and that gets covered separately as part of deferred tax or Ind AS 12, which we have talked about. So it is actually trying to cover all other types of government grants, right, which intends to benefit a company or support the setting up of an infrastructure in a particular area or location, right? Of course, government do provide assistance to individuals as well, right? And we are not talking about individuals. Let's say a very simple example of government providing assistance to individual is, let's say, Prime Minister, housing support program, right? Now, the housing support program, in the housing support program, the government provides interest subsidy, right? Now, that interest subsidy which the government provide is actually a type of government grant. But we're not doing accounting for individuals, as we know. We are doing accounting for corporate setups, right? So what are the types of incentive which government do provide to corporates at large? And then what are the accounting implication of that, from that perspective? So all of that is what we intend to cover as part of this accounting standard. And again, we'll try and cover this with the help of understanding of the principles, and then we will try and understand with the help of number of examples, right? Number of examples. So why do we need this standard? We need this standard to understand the meaning of the term government and government grant. So you may receive, actually, when we talk about government, it can be central government, it can be state government, it can be any, in a way, government authority which has the power and the ability, in a way, to incentivize any corporate from that perspective. And similarly, when we look at a government grant, we're trying to say that what is the benefit, right? In a way, grant has to be some kind of an incentive or benefit which is to be received by that corporate enterprise. And then we will try and talk through as to what are the principles for recognition of government grant, including non-monetary grant, right? So many times government provides incentive by way of monetary, which is say that they'll actually cut a check and give that money to that enterprise. Or many times they actually don't cut a check, but they give incentive by way of non-monetary asset. For example, they may give you land for free, or may give land for a subsidized rate for setting up a plant in a particular location, right? Now, that's also a type of government grant, which we will try and understand. How do we account for that? What are the accounting principles for repayment of government grant? Many times that you received a grant, but you have to refund that money which you received from the government. We will try and talk through that as well. What are the presentation requirement of grant related to assets and income? So again, what are some of the disclosure related aspect from an asset perspective, from an income perspective? So Ind AS, as we've been talking about, is big on disclosure. So we're going to try and understand that, and if there are any other matters related to government grants. So all of that in its totality is what we will try and understand as to how does the impact of any intervention from a government or a regulator perspective, and which results into an incentive to a recipient of an organization. How do you account for that? Of course, if the organizations give it to the government, then when you give, it is either you give in the form of taxes or you give in the form of penalties, or so on and so forth. So there are separate standard who deals with that. Here we are talking about when you actually in receipt of an incentive, right, from a government authority, whether it's a federal or state. how do you account for that, whether monetary or non-monetary, and then what the disclosure or presentation matter. All of that is what we will aim to cover, again with the help of several examples. But first, let's try and understand the importance of this topic from the perspective of examination. And what you see here, this topic has been reasonably okay. I think it has been covered. So as what you see here, number of attempts, it's been covered. The marks allocated are 4 to 5 marks. So you can actually assume possibly that there could be a question or two, one question in one particular term, which may likely to come from this topic for 4 to 5 marks, and that's the trend is what we see consistently over number of examination attempts, right? So 4 marks in November 19, or 5 marks in November 18, or 4 marks in November 17, or 5 marks in November 15. So I think it is relatively, I think it's a less complex standard. I must say that it's a less complex standard, and you should be able to very quickly understand the principles around accounting for different types of government grant, and then you should be able to then once you clear in your mind about the principles, you should be able to then pick it up any question, any situation in relation to government grant, from that perspective. So moving forward to talk to you about the scope and recognition. Remember what I said, any standard, you need to understand what's the purpose for which the standard's been written, and we've talked about that. Then you need to understand the scope, right? What type of transactions are covered in relation to this particular standard. And very important way of trying understanding the scope is that if any specific transaction which is covered in any other accounting standard, right, then you need to go and deal with that in other accounting standard. If that's not addressed in any particular other accounting standard, then you come in here in DS 20 to deal with the government grant or government assistance related matter, and we will try and understand this in a little bit of more detail. So Ind AS 20 in a way should be applied for, right, all type of accounting and disclosure of government grants and disclosure of other forms of government assistance. Now, this other forms of government assistance is not something which is, is described in great degree of detail, but essentially what we're trying to say that if you have received grant or if you received any other, in a way, support or incentive, from government authorities, you need to be able to appropriately capture that. Remember, the whole purpose of accounting is to demonstrate is that, what are your assets, what are your liabilities, what is the capability of the enterprise to generate revenues, and for which how much expenses you've incurred. And if actually there is a third party intervention, which is government, let's say in this case, in which has helped you for your performance, helped you in generation of income, or helped you in creation of an asset, or that result into recognition of a liability, you should be able to capture that, right? That whether this has happened because of the intervention by the government, or this has happened because of your own enterprise efforts, strategies, and things like that. And that's the whole purpose. Try to make sure that your financial statements represent the true and fair view, right? True and fair view. And hence we're going to deal with accounting and disclosure requirement of government grants, as well as disclosure of other forms of government assistance, which can come in any other form. So very commonly in terms of the disclosure of government grants, as I said, what are the types is what, let's say we see, for example, they may incentivize for setting up, setting up of a factory, right? Setting up of a factory in a remote zone, and for which they say, I'm going to give you land at a concessional rate, right? So they may give us what we call it as capital grant, so to say, right? Though there is nothing called capital grant, it is something grant which has been given in relation to assets, right? Formation of an asset. Or there could be a grant which has been given in the nature of revenue generating activity. For example, we've seen many examples where governments say that I'm going to give you a sales tax subsidy, right? So if the normal rate of tax is say 4%, If you were to set up a plant in a particular area, and if you were to start generating income, actually, you can charge tax at the rate of 4%, but you don't need to pay that tax to the government in a way. So that is like a tax, sales tax subsidy. So this 4% becomes an additional realization, from their perspective. We see, government giving grant in the form of what is commonly understood as SEIS, which is nothing but service-led export incentive scheme. Okay, so if you're doing an export of services, government also incentivizes industry. Very recently, I'm sure a lot of you understood, a lot of you thought about it, or read about it, is this whole PLI scheme, right? Which is the production linked incentive, right? Production linked incentive. So that's also a form of a government grant, right? The production linked incentive, in which the government is saying that if you, for setting up of electronics manufacturing in the country, that if you register with the government authorities and if you set up your plant and you do export of the mobiles or other electronic components which you're going to manufacture, you are actually entitled for an incentive to receive cash from the government of India, depending upon different slabs, is what they're going to notify, or what they may have already been notified. So these are different types of schemes which do government run, whether they help you in relation to, let's say, a lot of grants government are giving in the current environment in relation to COVID, right? So if you're a company which is investing in doing COVID research and all of that, so government is actually doing a lot of funding for doing such research or vaccination or things like that. So you need to understand that what type of benefits you've been receiving from the government authorities, and then are you receiving this benefit from the government in the capacity of the government as a customer, in the capacity of the government as let's say a body which in a way is responsible for the trade, promotion, well-being of citizen, supporting the industry, etc. So these are policy interventions. Normally government grants are come in the by way of policy interventions, right? And that's what nothing but is the SEIS scheme, which is a service export incentive scheme, or PLI scheme like production linked incentives. So many times we see government gave incentive to sugar sector, right, in the country, where you borrow, they say if you borrow money to clear your dues to farmers, the amount of interest is what I'm going to subsidize for that matter, right? So that interest subsidization is also a type of government grant, from that perspective. Very commonly we see government giving up land at concessional rate for setting up factories, right, in remote locations, for developing infrastructure, etc., etc. So you got to understand that what is the intervention the government is trying to make, what is the purpose for which they are trying to make, for you to appropriately determine and understand that what is the accounting impact of such government grant. And we will try and understand all of this with the help of very, very detailed examples. So quickly to look at the scope exclusions, right? Things which are not covered as part of Ind AS 20. So if there are any special problem in reflecting the effect of changing prices, so something to deal with, let's say, inflation or anything like that, if they were to come up with benefits that are available in determining taxable profit or tax loss, right? I talked about this. So this is something which is going to get covered under Ind AS 12. Government participation in the ownership of the entity as a result of any government intervention, they become the shareholder, right? Now that's not a government grant. It has to come free of such shareholding constraints and things like that. So government grant covered by Ind AS 41, agriculture. So if there is something which is to deal with in the agriculture standard, I'm going to talk about this in Ind AS 41, and we're not going to cover it here. So important thing for us is to remember is that if something which is covered specifically in any other standard like Ind AS 41, that's excluded from the scope of Ind AS 20. Similarly, if it is to do with the income tax or tax losses, is again excluded, and that has to be dealt with in Ind AS 12. And if there are any other form of incentives, which is to deal with change. For example, MSP, the government do provide help to farmers on minimum support prices, right? Now that minimum support prices support is nothing but, is excluded from the scope, so to say, from Ind AS 20, because that's more of supporting changing prices. The government say, I'm going to buy this particular commodity at this particular price point. So it's their decision, and that's they are the setting the market prices and things like that. And hence that's been considered outside the scope of Ind AS 20. So what we're going to do is that try and help you understand some of the definitions we talked about, and then we'll try and understand the accounting, and then we'll try and understand this with the help of several examples. So when you talk about government, government covers the central government, the state government, the agencies and similar bodies, whether local, national, or international. So if you're a company who has operations in multiple geographies, multiple jurisdictions, you will be able to cover all of them, right? Any incentive which you receive. Let's say, we know, right? In UK, for example, because of COVID, government has started the incentive program on Eat Out and Help Out, right? To say that if you go if you go out and eat actually in one of the restaurants which is registered with the government as part of their program, the government actually picks 50% of the bill, right? So if the bill is of £20, £10 is what you pay to the restaurant, £10 is the restaurant recover from the government, right? Now that in a way is an incentive given to the restaurant in a way to promote their business. So suddenly the cost of carrying on operations from a customer standpoint comes down significantly. So more customers are actually incentivized to go out and have food outside, and in a way it helps to revive the economy faster than what it will be otherwise. From that many government around the world, because of COVID, again been supporting economies by way of just mailing out checks for continuous support of employment, right? Now that's also a form of government grant. In India, the government has also launched several programs, for example, providing support to micro, small and medium enterprises in terms of giving guarantee for the loans which has been going to borrow by them. So that's also akin to a government grant, because if there's a default on the loan by the borrowing enterprise, the lender is actually insulated from the credit loss. Because the lender has been insulated, the borrower loan is actually guaranteed by the government of India. So it has an element of in a way government grant, so on and so forth. So there are several instances, and I just talked about the whole scheme of production linked incentive scheme, the PLI scheme, which has been talked about at length. So there are different types of incentives which the government authorities keep on running. So when you again think of the government grants are assistance by government in the form of transfer of resources, to an entity in return for past or future compliance with certain conditions relating to the operating activities of the entity, right? So there has to be certain conditions, otherwise everybody will want free money, right? So government again can't dole out free money just like that, right? So there has to be conditions, like in this whole production linked incentive scheme which I talked about. There are conditions, right? You have to set up a plant, you have to do the manufacturing in India, then you have to do export of those goods which you're going to manufacture, and then you have to export so much in this period, so on and so forth. So there are multiple conditions. Then you have to generate, in many situations we see you have to generate so much of employment, so much of local employment. There are several types of conditions which are attached, from that perspective. So you need to look at that and then consider it appropriately for you to determine whether it's a government grant or whether it is coming in from a government, from that perspective. So all of that is extremely important. Let's quickly talk about government assistance, right? Government assistance is an action by government designed to provide an economic benefits, right? Specific to an entity or a range of entities qualifying under certain criteria, like technical or marketing advice or a government procurement. So for example, if the government say, I'm going to buy this in bulk, like a lot of these procurement arrangement we see, right? The government to government contracts, where they do the government will become the sourcing and then they will pass it on. Either they're going to pass it on, normally they do it for defense purposes, but if they want to do it for some other national strategic national reasons from that perspective, then they pass it on to corporate enterprise. Then it becomes a subject matter of evaluation to say that is there any form of government assistance which I have received, and hence I need to appropriately account for or at least disclose if necessary, so that financial statements are not misleading for in terms of its form, nature, extent, and duration. So the whole idea is that how do you distinguish the performance of the enterprise of its own vis-a-vis the performance of the enterprise as a result of a government assistance or as a result of a government intervention. And that's the reason that we need to appropriately understand all the transaction, whether a direct benefit or an indirect benefit of what an organization has received from government, and then appropriately capture that information, evaluate the accounting and reporting consideration in a way, and in a way disclose that from a financial statement perspective. So any unfulfilled condition, other contingencies is what we'll have to capture and disclose. Let's look at the recognition. How do you recognize? When do you recognize a government grant? Recognition is only if there is reasonable assurance, right? If there is reasonable assurance that entity will comply with conditions, whatever the conditions which are attached to the government grant, you will be able to fulfill all of those conditions, and and the receipt of the grant is again assured, reasonably assured. The government will actually give you the money. Many times, it happens that you continue to complete the paperwork, and government changes, the policy changes, so on and so forth. So you got to be cautious in terms of, we see normally people are more conservative in terms of assessing this reasonable assurance. What is the meaning of this reasonable assurance, right? The term used in the standard is reasonable assurance. And again, it's a matter of judgment that how do you interpret this reasonable assurance, right? So assuming that you are reasonably assured, right? So from a recognition perspective, the term reasonable assurance has not been defined, right? So you need to apply an element of judgment and then appropriately determine. So what I was saying, that from interpretation perspective, we see companies here take more conservative approach, and many companies actually account for government grant as income in their P&L only when the grant is received, right? So the standard do not mandate you to that you will only account for this as income when it is received. You can actually account for this as income if you believe that you have fulfilled all the conditions, or you'll be able to fulfill all the conditions, and grant will be received. And then you're going to follow recognize government grant following an appropriate recognition pattern, and we're going to talk about that as well. Just because you fulfill the condition, just because you received the grant, does not mean that it becomes my income, right? So we need to also understand the pattern of recognition from a government grant perspective. Let's look at this example now. So this example suggests that the government of India provides a grant of INR 50 lakhs for research and development of swine flu vaccine to Star Pharmaceutical Limited, even though there are vaccines available in the market which are expensive. Okay. Now, Star Limited, by developing a manufacturing process, has to ensure that over a period of 3 years, the cost come down by at least 25%. Now, you are required to examine how the government grant be recognized, assuming that Star Pharmaceutical Limited has reasonable assurance that the condition pertaining to the grant will be complied with. So if the condition pertaining to the grant, so when do we record a government grant? When we record government grant based on the principle that the it is likely that the grant will be received, okay, and you will be able to, you will be able to fulfill all the conditions which are related to the grant, from that perspective, right? And then so that becomes a recognition, and then you do the attribution of that recognition through P&L, depending upon the conditions which are required to be fulfilled here, right? So here we are kind of fact is saying that it's R&D, and I need to reduce the price over a 3-year period, right, to 25%, and I'm reasonably expected. Here it is, there is a reasonable assurance, right, that the condition pertaining to the grant will be complied with. So what do I do? I'm going to look at the recognition principle. Recognition principle suggests that they are recognized when there is a reasonable assurance that the grant will be received, and the entity will comply with the condition. If I'm going to meet these criteria, then the grant will be recognized in financial statement as income over the period on a systematic basis, right? That's the another important thing here, income over the period on a systematic basis. It may be upfront, it may be over the period, but you got to determine on a systematic basis. It has to be logical. Then in this particular situation, since it is there is a reasonable assurance that the condition pertaining to the grant will be complied with, I know the amount, all of that. So considering that the Star Pharmaceuticals, will be able to meet the condition over a period of 3 years, the grant should be recognized as deferred income and credited to P&L over a period of 3 years. All right. So let's move. We've talked about this example, right, on the loans which have been, given either at a subsidized rate, or government may times forgive the loan as well. So if the nil or low interest loans, is like a form of government grant, loan must be recognized at fair value in accordance with Ind AS 109, and Ind AS 109, as you know, suggests that all financial instrument, the initial recognition of all types of financial instrument is at fair value, always at fair value. There is no exception to that rule, right? All financial instrument initial recognition is at fair value. So the loan must be recognized at fair value in accordance with Ind AS 109. The difference between the cash which is received and the loan amount is recognized and accounted for in accordance with Ind AS 20. So if there is an element of government grant or a government incentive, because either the loan has been waived off, or because there is no repayment which is required, then you need to appropriately account for it under Ind AS 20. So I'm going to deal with this example now, which in a way provides some more perspective in relation to deferred grant. So Platinum Limited received a loan of INR 1 crore at the rate 5% from the state government, payable after 5 years in a bulleted payment. So I have to make this payment after 5 years in a bulleted payment. The prevailing rate of interest is 12%, and how much I'm required to pay here? 5%. So certainly there is an incentive here. It's like a, prime minister, let's say housing scheme or this scheme or that scheme. And many times we see in our scenario, we do see, subsidy being provided to sugar sector, right, on interest subvention and all of that. It's like an interest subvention scheme. Okay. So instead of paying market rate of interest, the government is saying that you pay only 5% at the end of each year. The fair value of the loan is calculated at INR 74,76,656. So total is 1 crore. Tenure is 5 years, and I'm going to pay 5%. So there is a fair value which can be determined, which is that nothing but the delta of 7% discounted for a 5-year period. Now, you're required to calculate the amount of government grant and pass necessary journal entry. You're also required to examine how will the government grant be recognized. Okay. So I'm going to do step 1. How much is the total grant? It's fairly simple. Total value which I received 1 crore. The present value is 74,76,656. The difference is nothing but the amount of government grant, which is what this is suggesting. So I'm going to look at it. Platinum Limited will recognize INR 25,23,344 as government grant, and will record the following entry on the receipt of loan. The cash is coming in, right? The bank account debited by 1 crores. Then I have to record a deferred income of 25 lakh, and I have to also record a payable, right, to loan account 74 lakh 76,656, which is the fair value of the loan. Okay. Now this 25 lakh 23,344 is to be recognized in P&L over a period of time on a systematic basis. Okay. Now we need some more information. Now, if assuming there is no information provided, then essentially you will record this based on your interest saving, right? But if you have more information, which you will see in a subsequent slide, right, then we will figure out how you kind of look at this whole systematic basis from an accounting and reporting perspective. But how do you just kind of quickly put together in a way a EIR template, effective interest rate template in this example, uh, which is fairly simple to put in, right? 1, 2, 3, 4, 5, 1, 2, 3, 4, 5, 5 years. I've started with 74 lakh 76,656. This information is provided for. What is the effective rate of interest? 12%. I'm going to charge 12%. What is that I'm paying for? 5%, which is 5 lakh on the gross amount of crore. So every year, this is the outstanding balance. On this you provide. So essentially, this difference between this and this is 25 lakh 23,344. So let's say you have no other information, right? And then what could be a potential systematic basis, which is the amount of interest saved in every year, right? Because this will be an interest expense. This is what you are anyway paying for. So the delta between the two is nothing but, so this will be charged to the P&L, okay? And the delta between the two, which is in this example, 4,97,200 should come as a government grant in the P&L in the year 1. Similarly, in the year 2, this will, sorry, it will be 3 lakh, right? Not 4, my bad. 3 lakh. Now it will be 4 lakh 44,862 will be in the year 2. Similarly, here 4 lakh 98,246. Then here it will be 5 lakh 58,036. Here it will be 6 lakh 25,000, right? So that could be one systematic basis, which is nothing but the amount of interest which you are saving otherwise is what you record as the deferred income coming to the P&L, and this is your interest charge in a way. So your interest charge is in a way represented with the government grant, okay, which you have received. That's one way, okay. But the total will not exceed 25 lakh 23,344, and your interest cost will be these respective amounts, which is what listed out here. I'm hoping this is fairly clear, right? Which is nothing but the template for computation of effective interest rate method, right? Okay. And all the information is provided, right? 12%, the present value, the government rate of interest, what you have to pay, and the remaining amount, and so on and so forth. The principal is to be repaid on at a annual day, at a bullet repayment, right? It's not a annual repayment. Had this been annual repayment, then of course accounting will be then different, right? The EIR will be different. Okay. Now let's further extend this example. And then say, with the same facts given in the previous example, you're required to now state how the government grant will be recognized in the statement of profit or loss, assuming the following. Okay. The loan is considered to be an immediate relief measure to rescue the company. Okay. That means there are no conditions. The loan is considered a subsidy for staff training expenses incurred equally for a period of 6 years. The loan is for financing a depreciable asset. So if there are different scenarios, right, you have to look at accounting differently, right, from a recognition to the P&L, right? So now when this is to be immediate relief, then what will I do? I'm going to record this immediately in the P&L. So will be recognized in the profit and loss account immediately. Okay. Now let's look at the second situation when the staff training for a period of 6 years, then I'm going to record this over a period of 6 years, okay? Linked to the estimated cost of training, right? So assuming it is to be incurred equally, then I'm going to amortize it over a period of 6 years on a straight line basis. Now the loan is towards financing a depreciable asset, then I'm going to simply look at this, adjust this with reference to the depreciation amount, okay?
The loan is towards financing a depreciable asset. Therefore, INR 25 lakh 23,344 will be recognized in the profit or loss on the same basis as per the depreciation policy applicable to that asset. So assuming, let's say you're following straight line method of depreciation and the life of the asset is 10 years, this 25 lakh I'm going to depreciate, I'm going to record in P&L over a 10-year period divided by 10. Okay, simple. All right. Okay, let's move forward. So I'm going to do this case study. So New Finding Limited participates in a Government of India sponsored program for the support of the R&D activities, where it received funds on the basis of R&D cost incurred. Okay, so New Findings Limited participates in a Government of India sponsored program for the support of the R&D activities, where it received funds on the basis of R&D cost incurred, which is up to 75% of the cost the entity incurs. The funds received are fully repayable by New Findings Limited based on a percentage of the sales of products derived from the R&D project sponsored by the Government of India. All right, no repayment is required if there are no sales by New Finding. However, the repayment period is not limited in time. Okay, interesting situation. So I'm getting a subsidy of 75% of the cost. Fund is fully repayable based on a percentage of the sales of product. No repayment is required if there are no sales. However, the repayment period is not limited in time. In addition, the grant bear interest, which will be paid on the same basis as the principal amount. The amount received and the repayment therefore are on a project by project basis. You are required to determine how should New Finding Limited account for the grant and its refund, right? So essentially, when you see this is like a forgivable loan, right? In a way, so I'm giving you money, which if you are not successful, then you don't have to pay. But if you're successful, then you have to pay it back to me, okay? And that's the assessment here we need to make, okay? So how do we approach this, right? So New Finding Limited shall treat the amount received from the Government of India as a forgivable loan. In this case, the repayment of loan will be waived if there are insufficient sales. The following shall be the accounting treatment under Ind AS. The company needs to recognize the amount received as a liability. So what you do initial recognition is a liability because you're not sure, right? And then at every measurement period, you have to make this assessment that is there a likelihood of making this repayment? If there's a likelihood of no, I'm not going to make this repayment. So in a way, if you believe I'm not going to repay this, then it's a way of liability write back. When you want to write back the liability, then it's a come as a credit to the P&L. If you believe I will pay it, then you pay it, right? But if you believe, if in one period you believe that I'm going to not pay it and then you return it back, in another period there's a change in assessment, then that's a change in accounting estimate, and then you go to write it back, in a way you go to record that liability again by debiting the P&L. So it's a slightly in a way messy kind of a situation. So you got to be careful and do this estimate at every reporting period, unless you have actually, so to say, let's say, disbanded the project completely, and there is no chance that you will be able to create any sales out of the product which you have tried to develop. That means you haven't been able to develop, right? So the company needs to recognize the amount received as a liability, okay, as long as the expected future benefits as a result of the research activity. The company shall review at the end of each reporting period whether there is a reasonable assurance, right, that part or all of the amount received will not be repaid, right, based on future estimated sales. In case there is such assurance, then de-recognize part or all the liability initially recognized with a corresponding credit to profit or loss. If in a subsequent reporting period, the company revises upward its estimate of future sales and therefore of future payments, a liability for any amount previously included in profit and loss are restated, right, are restated with a corresponding debit in profit and loss. Also, interest should be charged on the principal amount as per the terms of the contract. All right, so both you got to keep on assessing both the activities. So quickly to, in a way, summarize what we have talked about. We've discussed the scope of Ind AS 20 in terms of in relation to government grant and also for disclosure of government assistance. And we talked about when you're going to look at the recognition of this is linked to when you're going to fulfill all the conditions which are prescribed, when you're reasonably assured that you're going to fulfill all the conditions which are prescribed as part of the grant conditions, and the grant will be received. So it's a reasonable assurance, and hence there is an element of judgment there which you need to be mindful of. And then there are multiple ways in which government do provide incentives. We talked about what's the definition of government, what are types of incentive. We talked about several real life example, right? Prime Minister housing subsidy plan, which is more catered to individuals. Then we talked about the plan around the production linked incentive, or the plan on service export incentive scheme from India, which is what government do incentivizes a lot of corporate entities. We talked about a lot of incentive government do give on account of setting up property plant or manufacturing facilities in remote locations or building the infrastructure. They give you land, etc. We also talked about grant may be received in the form of monetary grant or a non-monetary grant, and then you got to, once you meet the recognition criteria, then you need to evaluate that how this is going to get then recorded in the profit and loss account, and that is to be determined based on a systematic basis. And we will try and understand this with the help of few more examples as to what is the systematic. In one of the illustration which we talked about, we saw that there was a 12 lakh rupees of grant which you received, and there are a number of scenarios, purpose for which the government has given you the grant. The purpose was for immediate benefit, record it immediately. Purpose was for you to give training to your staff over a 4-year period, then you record it over a 4-year period. Purpose is to finance the purchase of an asset, and then there will be depreciation cost over a 4-year period, so record it over the depreciation period of such property, plant and equipment. So you got to understand the purpose for which the grant has been given for you to appropriately determine the P&L treatment or the systematic basis through which you need to record such grant in the profit and loss account. Let's look at the matching of grant with related expense. So recognition of recognize in the profit or loss over the period matched with the related cost if it is related to asset, and if it is related to income, recognize in profit and loss in which the specific expenses. So if it is related to assets, you're going to look at it over the period matched with the related cost for that asset, the related cost. And normally for asset, for example, depreciation is a cost which goes into the P&L. So you normally match it to the depreciation policy. The depreciation policy straight line, do it on a straight line basis over the period of such asset. From that perspective. Similarly, recognize in P&L if it is related to income, you do it when the specific expenses, like the training expense example, if it has been given to incentivize you to provide training to your employees, you do it over a 4-year period, over which you're going to provide the training to your employees. So you got to be, again, as I said, very, very mindful of the purpose for which, in a way, the grant has been given. Grant relating to past cost with no further cost shall be recognized again in P&L immediately, because there is no further obligation, no condition, no future cost in a way to be incurred which is associated with the grant which you have already in a way received, right? Now let's quickly look at the presentation, right? If it is a grant which is related to assets, you're going to record that as a deferred income in the balance sheet at fair value at the initial recognition, and then reduce the cost by the amount of the government grant. So these are in a way two possibility. So either you record this as a deferred income, or you adjust the value itself in the carrying value of the asset itself, and we will try and understand this with the help of an example as well. If it is a grant which is related to income, separately as other income under profit or loss account, or can be recorded deducted in reporting the related expense. Now again, this is something which is a matter of ordinarily accounting policy choice, right? We see this is an accounting policy choice, but this choice has to in a way represent the fact pattern, right? Choice has to represent the fact pattern, that for what purpose the government has given you what type of expenses which you are incurring to earn the grant or fulfill the conditions so on and so forth from that perspective. So you can either record this as other income or record it as a deduction of the respective expenses which you have incurred to earn the grant or to fulfill all the conditions. If it relates to an asset, right, you can record as a deferred income and then record as a credit in the P&L over which the depreciation period, or actually reduce the grant value from the carrying value of the asset itself, right? Both possibilities exist. Let's look at this example, matching of grant income with related expenses. So Sunshine Limited receives an asset related grant of INR 1.5 crore from the state government for setting up a factory in an area devastated by earthquake. The grant pertains specifically to the cost of the new factory, which is INR 3 crore, which is to be depreciated over 30 years. Assume no residual value and straight line methods of depreciation. You are required to determine how would the items appear in profit and loss and balance sheet at the end of year 1 if the grant is to be treated as deferred income or as a reduction in the carrying amount of the factory. Okay, so remember the principle we talked about, right? That if a grant related to a fixed asset, right, you can do accounting two ways. One is that either you do a gross recognition of asset and then setting up a deferred grant, or you can also reduce the grant from the cost of the asset itself, right? Both with suitable disclosures in both cases. Both approaches are acceptable and permitted, right? So now if I were to do both, how do I account for in this situation? How much is the total cost of the asset? 3 crores. How much is the grant I received? 1.5 crore, and the life is 30 years. Now here I don't have any other assumption here to say that whether there are any other conditions, as I'm assuming that I met all the conditions. Okay, now let's look at the solution. Grant is, if the grant is treated as deferred income, then I'm going to capitalize my plant at 3 crores and I'm going to record a deferred income at 1.5 crores, and I'm going to depreciate them, and record this as income. Okay, so depreciation of factory, 3 crore by 30 years, right, is 10 lakhs. Government grant, which is the income record, which is 1.5 crore over a 30 year systematic basis, right? Another 5 lakhs. So net charge to P&L is 5 lakhs in a way. Then on balance sheet, I'm going to record my current non-current asset as a fixed asset as how much? 3 crores minus the depreciation, right, which is 2.9 crores, right? 2.9 crores. Okay. And then non-current liabilities is deferred income, 1.5 crore minus 5 lakh is 1.45 crore. Okay, I think there is some miss here. Okay, grant treated as reduction in the carrying amount of the factory. Okay, now if I were to treat this as in the carrying amount of the factory, so in the statement of profit and loss, essentially then there is no uh, income coming for the government grant. It's just all getting factored as part of the depreciation itself. So my depreciation of the factory is now 5 lakh, which is because my cost itself has reduced from 3 crore minus 1.5 crore, which is 1.5 crore divided by 30. In my balance sheet, I'm going to record tangible non-current asset is 3 crore minus 1.5 crore minus 5 lakh is 1.45 crore. So essentially the outcome is the same, but there are two different way of presentation in a way, right? There are two different way of presentation. So here it's 1.5. Here if you look at 2.9 minus 1.5 is 1.45, right? So outcome is the same, but there are two different way of presentation. All right. Let's look at another example on a income related grant. Okay, so Moonlight Limited receives government grant for setting up approved capital intensive activities in SEZ area. The other conditions attached are that the company shall need to employ the locals for a period of 20 years. You are required to determine how should Moonlight Limited account for the income related grant. All right, we have very limited information here. So essentially, if I'm receiving the government grant and I have to do local employment, so I have to again record this as a government grant over a period on a systematic basis, right? So conditions are that the grant I'll be able to receive it, okay, and there's a reasonable assurance that I'll be able to fulfill all the conditions, okay. So here the income related grant should be matched with the cost of meeting the grant over the balance period of employing the locals each year. Moonlight should defer a portion of the grant received over the balance portion of the 20-year condition attached to the grant. Simple. All right. And many times this is to say, how do I treat this? Is this an income grant? Is it a capital grant? Should I adjust? Should I reduce it from the balance sheet itself, or like a nominal value? What do I do? So there are some areas of judgment, right? There's some areas of judgment here. Okay. All right. Let's look at another example. Example for income related grant, right? Entity B receives government grant in Northeast India in return for setting up of approved capital intensive activities in the Northeast states. The other conditions are that the entity shall need to employ the locals for a period of 10 years. So you need to generate employment for a period of 10 years, and you also need to incur cost for setting up the project. How should entity B account for the income related grant, right? The income related grant should be matched with the cost of meeting the grant over the balance period of employing the locals each year. A portion of the grant received should be deferred over the balance portion of the 10-year condition, because I need to maintain the employment of the locals for a period of 10 years. Maintain employment means I have to continuously pay the salaries, I have to continuously engage with them, train them, so on and so forth. So many types of cost, which of course they're also working, so they're all generating benefit, but the government is incentivizing me to keep them in my employment, and hence the cost which I've incurred, so the benefit which I received, that is going to be matching, and I'm going to record the benefit over a 10-year period, in this example. There are situations that you may receive grant in relation to non-depreciable asset. And what are non-depreciable assets, right? Land, right? Land is ordinarily a non-depreciable asset. So a grant related to non-depreciable asset may also require the fulfillment of certain obligations and would then be recognized in P&L over the period that bear the cost of meeting the obligation. A very simple example is a grant of land, right? May be conditional upon the erection of a building on the site, and it may be appropriate to recognize a grant in profit or loss over the life of the building once the building is constructed and put to use. So the grant was for in relation to build in land, but the land is non-depreciable, but the conditions suggest that you got to set up a building and make it operational over a 3-year time frame, and then you're going to of course generate future economic benefit by way of occupation of that building. So how do you record this in the P&L? You can record possibly this in the P&L in two different forms, right? One by way of reducing from the cost of the building itself, or the other one is record the deferred income and then record it in the P&L over the period of the depreciation of such building, from that perspective. Let's look at another scenario where there's a conditional grant received as part of a package of financial or fiscal aids, right? Now, if that been the case, in such cases, the care is needed in identifying the conditions which are giving rise to cost and expenses which determine the period over which the grant will be earned. It may be appropriate to allocate the part of a grant on one basis and part on another. So you got to again be very, very clear the purpose. So remember the recognition criteria, that you will be able to fulfill the conditions and grant will be received. Once you've done the recognition criteria, then you have to determine that over what period I'm going to record this in my profit and loss account. Then you need to evaluate that whether it is asset related or whether it is income related. If it is asset related, you may present it by way of recording on a net basis from the cost of the asset itself, or by recorded as a deferred income and then appropriately crediting the P&L based on the recognition of an expense, right? If it is related to an income related, you're going to record this as income in the P&L depending upon the conditions which are required to be fulfilled, and the cost which you're going to incur to fulfill the conditions. So if there is no condition as an immediate assistance, come the P&L on an immediate basis. If there are conditions like generate employment, conditions like give training, conditions like do the production, so on and so forth, then you're going to record it over a period of time. And when you record it in the P&L, you can record it as other income, or you can record it as a reduction of the respective cost itself. And that's something is an element of accounting policy choice, which again you need to apply carefully and then disclose it appropriately, right? So let's look at this example of grant for expenses or losses which are already incurred and for immediate financial support. So if you've already fulfilled condition, the cost has also been incurred in the past. What does that mean? Whatever money I'm going to receive it from the government through this government grant is going to get recorded in my profit and loss account on an immediate basis, right? A government grant that become receivable as compensation for expenses or losses already incurred, or for the purpose of giving immediate financial support to the entity with no future related cost, should be recognized in profit or loss of the period in which it becomes receivable. In some circumstances, a government grant may be awarded for the purpose of giving immediate financial support to an entity rather than as an incentive to undertake specific expenditure. Now, in this case, you've got to record this immediately with appropriate disclosure to ensure that its effect is clearly understood, from that perspective. It's, we don't see this on a common basis, right? This is uncommon that government will give you grant and will not attach any conditions or will not demand performance. But in COVID times, we do see some of that the government is simply shipping checks in a way to companies, either to support employment, support the business activity, in a way, so on and so forth. So there are possible scenarios which government may do. So there are scenarios when we receive grant which are without conditions, right? So government gives a grant of INR 10 lakh for research and development of H1N1 vaccine to XY Pharmaceuticals Limited. There is no condition attached to the grant. Examine how the government grant be recognized if the grant is given on the basis of existing research. That means for the past, right? So you're going to again record this on an immediate basis. Entire grant should be recognized immediately in the profit and loss account. Let's look at another example of a non-monetary government grant, right? A government grant may take the non-monetary, like land, like where the government is giving you by way of assets, right? By way of assets, right? Not by way of monetary asset, but by way of non-monetary asset, right? Which is land, building, inventory, so on and so forth. So the government may grant you in the form of a transfer of non-monetary assets, such as land or other resources, for the use of the entity. In these circumstances, the fair value of the non-monetary asset is assessed, and both grant and assets are accounted for at either nominal or fair value. So you have an accounting policy choice, right? You can either record, as I said, a grant which is related to an asset. You can record that at fair value and then record that as deferred income and over the period of time, or you may decide to knock it off from the carrying value of the asset itself. And then essentially, if the asset is received free from the government, then you're going to record this at nominal value to ensure that you have proper control, right, over that asset. If you don't record it at nominal value, then this asset can be misappropriated, and hence it is important for you to record that at nominal value if you decide to do nominal value or net accounting for such non-monetary government grant. So here, Good Luck Limited requires 10 acres of land to establish a manufacturing unit in a SEZ area. The government provides a land on a leasehold basis at a nominal value of INR 5,000 per acre. Okay, nominal value of INR 5,000 per acre. The fair value of the land is INR 50,000 per acre. Okay, how much I'm required to pay here? 5,000. Fair value is 50,000. Now again, you are required to calculate the amount of the government grant to be recognized by Good Luck Limited. Remember what policy choices you have? Your policy choices, again, this is a capital grant. So you have two policy choices, right? In a way, you record this either on a gross basis or at a nominal amount, right? Both options are available. Okay, so I'm going to look at option one, recognition criteria that assessed in both grant and asset are accounted for either nominal or at fair value. Measurement under given scenario, Good Luck Limited will recognize the land at fair value, which is 50,000 into 10 is 5 lakh, and INR 4 lakh 50,000 as the amount of government grant. Okay, alternatively, I may only record 5,000 is what I need to pay, into 10 is 50,000 as the value of the land. Okay, right? And of course, I have to also examine Ind AS 116, right? Here, in terms of recording the right of use asset and so on and so forth. So you record this as a right of use asset, right? The land will be recorded because on a leasehold basis. Okay.